Hello, I'm Stephen Mayne, contributor at Intelligent Investor, founder of Crikey and shareholder activist.
And I'm James Thomson, senior Chanticleer columnist at the Australian Financial Review.
And we are the Money Café, James.
Yes.
Well, hold on to your hats, hey? Trump, Musk, Ramaswamy, where do we start?
Well, I reckon the timeline is interesting here, Stephen. Like, you know, Musk has, I guess, drifted to the right, and he started the year sort of, you know, seemed to be broadly supportive of Trump. And then on, I think it's July 13, Trump, there's the assassination attempt on Trump, and Musk goes full cheerleader, endorses Trump's campaign, sets up a political action committee, and, you know, 4 months later, he's wormed his way into the inside of the Trump camp, and now he's been given this extraordinary role as running this Department of Government Efficiency. But he could do anything here. His scope is amazing. Like, he can change the way America works by changing the way the government works. So I just can't believe how quickly this has all happened. It's like something out of a movie.
Yeah, look, it is bizarre. I mean, I'm a bit of a believer of the, watch what Trump does rather than what he says. Sure. So we've still got 75 days to go. I mean, for all I know, Musk won't even become a government employee because the conflicts of interests are impossible under the current laws. So, but like I agree, his access and his influence already, the fact that he was talking directly with Putin through the year as well, was on the call with Zelensky. So it is amazing how he has inveigled himself into the Trump orbit. And, he is the most extraordinary business figure of all time because he, created Starlink and rockets. So he literally is almost beyond the control of governments.
Yeah.
There's no Starlink in Taiwan at the moment. He donated Starlink into Ukraine to help, but didn't activate it in Crimea. I mean, his connection to all of that technology, global. I think that's what, and the fact that he's the richest bloke in the world and controls Twitter. Yeah, that's what makes him just so ridiculously amazing.
Yeah, but it's. I mean, you're right about watching what Trump does rather than what he says. But I mean, what he's saying at the moment is pretty extraordinary. I don't know if you've seen this video he put out about what he plans to do in education, for example. He's going to cancel or sack a whole bunch of accreditors who provide accreditation to academics in the US. They're all going to be sacked. They're going to be replaced with people who teach what he and his supporters believe is a more traditional form of education. And he's going to try and change the entire university sector. I mean, does he pull all this off? Does he get distracted? Does he care about any of this stuff? Or is it just, reading what's on the teleprompter? I don't know. But gosh, there's some seriously big changes. I spoke to a geopolitical guy. He's, the first 5 weeks of the Trump presidency, who knows what's going to happen? What's he going to do about Iran? What's he going to do about Ukraine? What's he going to do about China? Like, could be an incredible period.
Yeah, and I think we've just got to remember that it's not a landslide. There's the House, the Senate confirmation processes. There's a Republican Party, so they're all those checks and balances, in my view, will slow him down.
Yep.
And his actual ability to, actually do amazing stuff, and then the backlash that will come if he does, wild things. So, you abandon the Inflation Reduction Act. Well, there's so many companies which have got their claws into that. You're hurting a lot of businesses if you take all that away.
Yeah.
So, I think it will be tough to actually start cutting. Remember when I worked for Jeff Kennett, like he cut the public sector in Victoria from 360,000 to 260,000. It was Thatcher-esque in the scale of what he did. And so you're going to get, big cuts, but it's just harder these days to take things away from people in this sort of social media age. So I just think that it will be difficult for him to take away stuff, and how he goes managing the backlash is going to be really amazing to watch.
Yeah, well, he doesn't have to think about another term though, does he, Stephen?
No, well, he's already a lame duck. But the problem he's got is that 2 years' time there's the midterms, so we'll already be into a new cycle. And the moment he starts making himself unpopular, and the polls start showing that the Republicans could lose the House and the Senate unless you slow down, that's when self-preservation kicks in with all the other elected reps up in 2 years, and that's when the discipline starts to come on the really crazy unpopular stuff.
Or when the bond market smacks him, Steve.
Correct. The bond vigilantes, inflation kicks up, interest rates go up. The market's discipline is not to be underestimated as well.
No, particularly when Trump is so enamored with using the S&P 500 and the Dow Jones as a sort of yardstick of success. They're already at all-time highs. I'm not quite sure why he thinks they can keep going up strongly, but anyway, maybe I'm wrong on that.
Yeah. Now, you've interviewed Dr. Doom, Nouriel Roubini. Has he got much to say on Trump and markets?
Oh, well, I think he sort of sees it as a bit of a hinge moment. Does Trump follow through on his big talk and impose these tariffs and cut immigration and send inflation back through the roof, or is he disciplined by either unpopularity or the market or his own party and takes a more benign path? And then he's when I spoke to him, he'd just flown in from Israel, and similarly in Israel. Does Trump's support for Israel embolden the Israelis to attack Iran, or does the threat of American involvement see Iran back off? So, again, the first 5 weeks could be pretty telling. But the one question I did ask Roubini, Stephen, that I thought was interesting for Australia was, what's the risk we're not thinking about? And his answer was China. Like, we're all thinking about the tariffs, yes, okay, and the sort of split view between this is just a bargaining chip from Trump, he won't follow through, to okay, he'll put tariffs and we enter a trade war. But Roubini's point was that there are hawks around Trump who say that you can't be half-hearted on China. You've got to engage in a full-scale economic war. You've really got to cripple their economy because it's us versus them, and this is the big clash of this century, and we want to win it. Now, is that going to happen? I'm not sure. But, geez, Australia would be caught in a real crossfire there. So I just thought that was an interesting sort of, unseen risk amongst all these risks, that we don't just get tariffs, we get some sort of broader economic war that's pretty ugly. Yeah, well, I do agree with you that the China-US relationship and how that flows will be the biggest thing to watch with the whole Trump presidency. Because you're right, China's on the rise. They've got 600,000 government employees involved in their sort of spying, influencing, some would say stealing, breaking into systems. They are a massive machine, hostile to the US, with a $350 billion plus trade surplus with the US that annoys Trump enormously, that trade deficit. So that will be I think the biggest issue to watch going forward. Now, Stephen, you've been on the AGM hustings for us.
Well, I was going to ask you actually, because I was just going to give you an example of how a typical calendar works. I mean, what do I do at 10 o'clock today?
Yes.
As we're talking right now, it's just after 8 a.m. At 10 o'clock, I've got Ingham's Chicken, Computer Share, or Goodman Group. I mean, that's 3 to go to. And then, 11 o'clock, you got Flight Centre. Then this afternoon, we've got Satire, which has been all sorts of scandals. And Guzman and Gomez's debut AGM at 10 o'clock. So it's just another day in AGM heaven for me. But I want to ask you about Goodman Group. You wrote a really interesting column the other day about their extraordinary pay system where, I mean, effectively, the employees get gifted, 1% of the company, or around $500 million a year on a good year. They get gifted that for shooting the lights out on performance, but the cost to the company of issuing those bonus shares is not included in the accounting measure of the operating earnings. It is an extraordinary situation, which you explained in a way I've never seen explained before in your column. To take us through how that all works.
Well, I've got to say, Stephen, up front, it wasn't me. It was my Chanticleer colleague, Anthony McDonald.
Oh, my.
Great job on this. So I don't want to take his I don't want to take his the credit for his great work. But you're right. This is a really interesting setup. So they pay themselves in big share-based incentives, and you go to lots of AGMs, Stephen. That's pretty common and pretty well regarded, right? It means the employees are alongside shareholders, so that's okay. But what happens is it's the measuring stick that they use to pay those shareholders, and they use something called operating earnings, which excludes the share-based payments. Now that's sort of controversial because what you've got is the operating earnings going up, great, but they're going up without the inclusion of the money that's already been paid to the shareholders. So in other words, the operating earnings would be far lower if you took these share-based payments into consideration.
That's right. The number that stuck out for me was the $2 billion of operating earnings, whereas the cash flow from the business was something like $860. So cash is always king. And frankly, I agree with the thesis that the whole thing is a bit of a rort. But because the performance has been so incredible, world's biggest and best industrial property manager, surfing the data centers boom and the logistics boom, everyone's happy. And they've got these three big index funds, which together own 27%. And because they oversell property ETFs around the world, which means that these index funds are long listed Australian property groups, and they don't take the governance long handle, particularly to the likes of a Goodman, and hence this scheme has not been overturned yet.
Well, Stephen, I guess I would challenge that a little bit. I mean, they're facing their fifth strike at today's meeting. Fifth strike in a decade. I mean, so the long handle's been taken, but Goodman's just ignored the long handle.
Well, that's the point. Is Goodman has been recalcitrant, if we put it that way. They just have refused to move. Whereas normally, like Macquarie got a 23% protest vote back in, I think it was 2007, 2008, because they were paying excessive cash bonuses, and they just immediately flipped to long-term share bonuses, and everyone's been happy ever since. Yeah. So you're right. Goodman has just refused to read the room, and they've had 5 strikes in 10 years, and at some point people are going to start voting against their directors, because obviously that's the ultimate power. Is a strike is meaningless unless you follow through and start removing directors who refuse to fix pay structures. But because everyone is making so much money, they've just said, if it ain't broke, don't fix it. Everyone's making money, so let's leave a beautiful system in place. But you're right; it's fundamentally flawed from an accounting and an incentives point of view. And hopefully this year's strike, which I think there will be another strike, will finally mean that they'll actually move in there and fix it.
But big strikes are becoming quite commonplace, aren't they, Stephen? You've seen a couple already.
Oh, look! I mean, platinum. 73%. When the founder, Kerr Nielsen, was sitting on the floor of the... Well, he wasn't personally sitting there, but his votes were sitting on the floor of the meeting, and it was, 51% on the proxies, and it finished up at 73%. He defeated the CEO's LTI grant. Perpetual 88% against the REM report, a massive strike. So, look, I've been surprised by the scale of the protest voting this season. I think it's been noticeably up. You've had, it's just even like big directors are getting, Tim Poole at Horizon, 14% against. John Mullen, double-digit protest votes because, you're too busy. Catherine West, your ultimate boss at 9, 17%. She's the new chair at 9, 17% against her re-election, and big pay protests there as well. So that has been a very interesting feature for mine of the season. And if you're looking forward, I ask you, what AGMs are you looking forward to over the coming weeks? Well, Lend-Lease on Friday. You've got the new chair, John Gillam, who is charming the shareholders, trying to get their endorsement. And, of course, WiseTech, Mineral Resources, the Murdochs, all their meetings are coming up November 2021. Star Entertainment, November 28. Are enough people going to the Star Brisbane Casino? That's where they're holding the AGM. So I think that'll be beauty. And then, of course, Myer and Premier in December, where you've got Olivia Worth, executive chair, all the related deals between Myer and Premier. I think that will be quite an interesting little AGM outing as well.
Yeah, absolutely. No, I think the 20th and the 21st and the 22nd are a big couple of days for AGMs. I think we've got MinRes, WiseTech, and as you say, News Corp. So, it's going to be required viewing.
It is going to be required viewing. And I also want to give a quick shout out to the dinosaur companies that are still banning online participation. So the ones coming up, Ramsay, HMC, Paladin, Premier, Mirvac, Kogan, Fox Corp, Downer, and the ones that have been, Stokes, Seven, Twiggy Forest, Worley, even BHP did it this year, Origin. So most good companies are getting with the program and allowing online questions and voting. So all of them today are doing it except for Ingenia, which has a $2 billion market cap, and IPH, which has a $1.5 billion market cap, both running dinosaur physical-only meetings in Sydney today. But, Goodman, I lobbied them. Don't, make sure you do a hybrid. They've done it. Even Satire, it's a controversial company. It's a virtual, but, virtual is better than a physical-only. So, yeah, for mine, it's been a great season. And I've been annoying all these New Zealand companies as well. I had one yesterday in New Zealand where the chairman, Rob McDonald, fielded a complaint from the floor that I was wasting everyone's time. And he responded by saying, well, there's been some press over here that he's going to write a book, the first 1,000 AGMs, and he's just chalked up another one for his 1,000. So,
were you wasting anyone's time, Stephen?
Well, I thought they were good questions. Although there was one funny one, like with the Kiwi AGMs, I always do the standard. We've now got, a public company CEO as the Prime Minister. So Chris Luxon, who's the old Air New Zealand CEO. Yeah, so, do any of our board or management, know him, from the CEO ranks? And what's one thing you want him to do to help our company? And is it good having a public company CEO as the Prime Minister? And the Chorus chairman, Rob McDonald, comes back and says, yeah, look, I do know him. I was his CFO at Air New Zealand for 5 years. So...
it's a bit of a small town, New Zealand. Sometimes I think everyone knows everyone.
And he said the one thing I want is faster approval for all our renewable projects, which is the standard request of any government: is get out of the way and let us get on with it.
Yep, indeed. Well, should we get to some questions, Stephen?
Let's do some questions. But before we do that, let's have a quick message from our sponsor.
In the world of investing, 10 years is a huge milestone. 3 of InvestSMART's ETF portfolios have recently reached this mark with style, outperforming most competitive funds along the way. To celebrate, InvestSMART is giving $100 to every new account opened and funded in November. With 10 expertly designed ETF portfolios from conservative to high growth and asset-specific options like international shares, you'll easily find a portfolio to suit your goals. Visit investsmart.com.au to learn more. Remember, past performance isn't a promise of future success. Terms and conditions apply.
All right, James. So Thomas has got the first question. Loves the podcast. He was going to come along to Alan's Q&A with Joe Aston, but wasn't able to make it. And he's got a question about the Greens' announcement that they're going to one-up the Labor Party's proposal to slash the HELP debt, the university HECS debt, by 20% by wiping out the lot and funding it with a Robin Hood policy of a super profits tax on every corporate making more than 5% on shareholder equity above the 10-year bond rate. So look, I don't know, where do you start with this? It's a harebrained green scheme, but the sensitivity around university debt is pretty extreme. Labor's moved dramatically, and the Greens are saying not good enough, and tax the rich to give every university student to wipe all their debt out.
Yeah, I mean, I think you'd agree with me, Stephen. Not going to happen. Corporate taxes are already very high in this country. I think business, as it gets close to the election, will be pushing for a corporate tax cut, particularly if Trump's doing similar. That probably won't happen either. But this is an interesting example, I reckon, in the wake of the US election. We think about the sort of more polarized electorates, inequality being an issue. I mean, this is one of those tax changes that aims to address inequality. You take from the rich, the companies, and you give it to the poor students struggling with their HECS debt. So Yes, I agree with you. Not going to happen, unlikely, but it is. This is the direction of travel, I reckon. I don't know what you think.
Well, I mean, I remember someone saying to me that the most unrepresented group in America now is multinational big business globalists. Like Trump doesn't like them, the Republicans are against them, but I don't know that is right. I mean, Trump seems to be able to persuade the working class and battlers that he's going to help them, and then he always comes in and does tax cuts for Wall Street, and all the bank shares soar, and everyone says it's all about deregulation. So, I sense that Trump is going to be a pro-business, tax cutting type leader again. Yes. And that does put pressure on other countries to match it. I mean, if we've got one of the highest corporate tax rates in the world, like we do in Australia, and then the US cuts it from 21% to 15%, that does put pressure on us to make ourselves competitive, to attract corporates and those sort of things. So, yes, you can go super profits taxes on things like coal, iron ore, it's one-off resources that are owned by the government. So that's in a different bucket, in my view, and we could do more on that, particularly the iron ore in WA, where the royalty at 7% is a bit of a joke and ridiculously low, and hence Gina Rinehart's worth 40 billion and Twiggy Forrest is worth 30 billion because they're just they're so lightly taxed at the state royalty level. But having a general increase in corporate taxes overall, you just can't afford to do that because you just won't attract the corporate inward investment that you need to stay competitive.
Agree. All right, Terry's got a good question. Speaking of Joe Aston's book on the Chairman's Lounge, with all the publicity about the Chairman's Lounge recently, I was wondering whether Australian companies pay fringe benefits tax on the value of the lounge membership, which would appear to be a benefit with respect to employment, and it clearly has a value. What do you reckon, Stephen?
Well, they absolutely should be paying FBT, and Qantas does pay FBT itself when the Qantas directors get free flights from Qantas. But I agree that the Chairman's Lounge membership is a fringe benefit to the chairman of the company or the CEO of the company, and I don't know absolutely how it applies, but I do know it is a very big benefit, and there should be FBT on it. So,
is it? I mean, is there an issue though? It's a gift from Qantas to that person. So if Alan Kohler Enterprises gave us tickets to, I don't know, Elton John's next concert, we wouldn't pay fringe benefits tax on that, would we, Stephen?
No. I think it all comes down to who is giving the benefit, isn't it? So if Qantas just comes along and says, I'm giving John Smith a benefit because she is a big, important person. But if a corporate says, we're entitled to 5 Chairman's Lounge memberships because, Macquarie Group is spending $10 million a year in Qantas, we're going to allocate these 5 to all of our directors.
Yeah.
And then I think if the company is providing the benefit, if the employer is allocating the benefit, then that's where I reckon the FBT would kick in. But from my experience, FBT, there's a lot of perks that perhaps arguably should pay FBT, like lifetime free parking for former directors, and those sorts of little trailing commissions. I do suspect a little audit might raise a bit more cash on the old FBT front.
Interesting.
Now, George says, love the pod. I'm sure you're loving another ETF question. Oh, we love the ETF question. So he bought into VTS recently, which is the US total market, and noticed that the price will fluctuate through the day on the ASX while the US markets are closed. Given an index ETF typically tracks the market, how are these price movements determined? Do US ETFs on markets like the ASX, the Nikkei, etc., effectively work like after-hours markets for the US markets? My head is spinning.
Yeah. I mean, I think the answer here is that the ETF trades on the ASX, and so it's determined by the buyers and sellers, what the buyers and sellers are doing on any one day on the ASX. Now,
correct.
The ETF tracks the index by buying and selling underlying securities in underlying US securities according to how the total market looks. So there's 2 different things going on there. The ETF tracks the market by buying and selling those securities in America, and then the price of that ETF is determined on the ASX by what buyers and sellers down here are doing. I think that's the way to think about it.
Exactly right. And just like a listed investment company, an LIC, there will be times when it trades at a discount to NTA and times when it trades at a premium. That's a buyers and sellers push, but the asset backing of the ETF is what is determined by the Vanguards and the BlackRocks of the world actually buying the physical stock and holding that to back the ETF. So that's why with the Goodman discussion earlier, they've sold so many Australian property ETFs around the world that they just have to keep on buying more and more Goodman shares to satisfy that global thirst to be exposed by ETFs to Australian property trusts.
Well, Dylan says, I've just finished reading Cameron Murray's book, which is called Rigged. In his book, Cameron states that by the early 2030s, total super tax breaks will grow to exceed the total cost of the age pension. Currently, the age pension costs the budget $53 billion in 2021, supporting 2.6 million pensioners, while tax breaks to superannuation currently cost $36 billion. Have we stumbled into this strange situation where the superannuation system is going to cost us more than the age pension? Thanks and great work with the podcast.
Well, I mean, that $53 billion is real money out the door in terms of the age pension back in 2021. Whereas the tax breaks cost is a sort of a nominal figure where it's an opportunity cost as if everyone in super was paying the marginal tax rate, we would receive an extra $36 billion more. But it just doesn't take into account how behaviour would be different if those tax breaks for super weren't there. Like some people would work less because they didn't want to be paying so much tax in the top bracket. Other people would be more into negative gearing or fully franked shares. So it would lead to other behaviours that you can't just say, abolish all super tax breaks and there's an extra $36 billion a year for the government budget of cash taken from Australian taxpayers.
Yeah, I haven't read the book, so it's hard to comment completely. But is there an issue, Stephen, here that the cost of the age pension will go down as well? So, the tax breaks looks comparatively higher, but it's sort of a good thing because more people are drawing on their super rather than the pension. I don't know. I might have that wrong.
Well, look, having $3.9 trillion in super has and will continue to reduce the amount of age pension liabilities that future governments will have to come up with.
Yeah.
But there is also a truckload of money in that $3.9 trillion, which has been tax driven by the wealthy who were never, ever going to be on the age pension anyway. And they are saving themselves a truckload of cash by being in the tax sheltered vehicle, which is Australia's uniquely paternalistic and enormous compulsory super system, which is a good segue for me to briefly ask you about what ASIC is doing to Cbus at the moment. I mean, isn't that extraordinary?
Well, look, poor old Cbus has had a year from hell. Obviously, the Nine Entertainment, the AFR, SMH, and Age have gone to town on the criminal links to the CFMEU. That's caused APRA to step in and look at Cbus's directors and governance systems, and now ASIC is going Cbus too. The sort of, I don't know if it's a dirty secret, but part of the issue in super is it's become very big, obviously, and a lot of the back office stuff, the paying of claims, the paying of insurance, that all that sort of boring stuff is handled by third-party providers. The biggest of those is a company called Link, which is now owned by a Japanese group called MUFG. To cut a long story short, MUFG has been struggling with claims handling. Apparently, they came out of the pandemic with a bit of resourcing issues. Claims have been paid late, and that has left super funds, including Cbus, and a lot more. There's more to come here, exposed to these the struggles at Link. Now, ASIC's got no truck with that. All it says is, hey, Cbus directors are responsible for the payment of those claims. If you want to use an outsourcer, if you want to do it yourself, we don't care, but you've got to be able to pay the claims.
And Wayne Swan is the chair.
Wayne Swan is the chair.
Simultaneously president of the ALP, which frankly I think is a very, very difficult, multi-hatted operation to maintain. They're being very belligerent, in my view. I mean, how can they shun the Senate and just simply refuse to turn up? I mean, Kerry Packer's the only person in history who's ever contemptuously, treated a Senate inquiry or a parliamentary inquiry and got away with it, where it's worked for them. To blank a parliamentary inquiry and just not front. I mean, they're going to be there today, belatedly, but they are being almost CFMEU-like with their belligerence and their thumbing of the nose. And I think they're in a world of pain, Cbus, and Swan in particular.
I think this is it's a weird one. I mean, I think industry super has done great things for the country, right? No argument about that. Look at the performance tables over a long period. Look at how every major overseas investor who comes to Australia, Stephen, tells me how great the super system is. So industry funds have been a big part of that. But the industry funds do see themselves as part of a movement, which is okay. That's sort of fine. But it creates, I think, this siege mentality. Everyone's out to get us, the other side of politics particularly. And I would say that hasn't been an unreasonable view. But by the same token, you're managing other people's money. We need to have confidence that the system works. If you want to take the plaudits for being a $100 billion fund, you've got to be able to pay these insurance claims out in a timely manner. Otherwise, the confidence in the system will crack. And I wrote this morning, it's not comparable, but look, before the Banking Royal Commission, no one had heard of the idea of fees for no service. It was a fairly technical, seemingly innocuous, hidden in plain sight thing. But it killed AMP, blew the joint up. Now, I don't think that's going to happen with Cbus, but you've got to be aware that these small things that you don't think are a big deal, and that are in the background, they're part of the infrastructure of the system, they can have seismic ramifications. And I think one of the ramifications here will be that governments will have to say, are we sure that the way we're running the way these industry super funds are being run, with directors plucked from employer groups and unions, is really sort of the best it can be? I'm not sure. Wayne Swan, I interviewed him a couple of weeks ago. He says, of course it is. Just look at the performance. Of course it's fine.
Yeah, well, the scoreboard, the performance is fine with scoreboard, and having lower fees and not having the profit motive, they have outperformed the for-profits, who've had their own conflicts. But there are still, I agree, I still am struggling to understand why they have so resisted the concept of independent directors. I mean, they vote for them everywhere. I think it is a bit of an anachronism now to have sort of unions and employer groups in joint majority control of their boards. I mean, it does mean you've got sort of neutrality, and nothing stupid can happen because each side has a veto on the other doing something partisan for their interests. But I do believe it should transition to more a professional independent model in the traditional mutual model where the members own it rather than the unions and the employer groups owning it. So I'd love to see that sort of transition, because I had a little example this week with the Lifestyle Communities AGM where Philippa Kelly was the chair of that company, and she was also the chair of the Aussie Super Investment Committee. And they underwrote a capital raising. They picked up a $40 million shortfall from retail shareholders. I was annoyed at Aussie Super, going after 15% of the company through underwriting capital raising with retail. The stock has since halved because of scandals exposed on 7:30 by Adele Ferguson, and they were still calling her the independent chair. And I'm saying you're not the independent chair when you're involved with Aussie Super, which is the biggest shareholder with 15%, and is doing capital raisings, which I thought were very poorly structured. So, I just sort of thought, what is Aussie Super doing with this sort of stuff? And then they got done over an $80 million fine, I think it was, for failing to process as well. So there's more governance issues emerging within the industry funds, and perhaps neutralising them and getting them away from the partisan industrial relations system and more power to their actual members, not their sponsoring organisations, unions and employer groups, would be the governance model that fixes this. Because, the Cbus story, it's a pretty ordinary story, and it's going to get worse for them, I suspect.
I think the simple test here, Stephen, change the name Cbus and stick the name of a big bank on instead. How do you think the house of protest would be?
Yeah. Well, I'm generally not a huge fan of whataboutism as a concept. Like people say it with all the time, but and I think because they are not for profits, and they don't have the motive like a big bank with a CEO making $5 million. I think that does take some of the cynicism about the incentive system of those in charge of industry funds. But I do agree that what has happened at Cbus is a problem, and there does need to be some governance reform. But historically, they have outperformed in the long term. But even the performance in the last 12 months is actually, the retail funds have made a bit of a comeback. So even that's been a bit up in the air. So,
I don't know, Stephen. I mean, these funds are going to be of a comparable size and definitely more systemically important than the big banks in a couple of decades' time. They are going to have their fingers in every corner. They already do have their fingers in every corner of the economy. They are funding things. They are owning things. They own all our airports. They own all our ports, a lot of the key infrastructure. I mean, I take your point about whataboutism, but I sort of think if we're not going to improve the governance here, if we're not going to, surely we should at least be open to making it better.
Yeah. Well, I agree. And as I said, the changes I would do would mandating a majority of independent directors, empowering the individual members, and reducing the power of the sponsoring unions and employer groups, and then mandating transparency all over them. I mean, quite a few of them have a nominal annual meeting. It's all voluntary, and not many people turn up. I mean, effectively they're ownerless from a member's point of view, and that is a problem. Because no one is there to actually hold the boards to account when things go wrong. There is no proxy advisor. There is no, Regal or Perpetual or 8% shareholder that will ring up the board and say, Swanee, I own 9% of Cbus, mate. These governance issues are a problem. We're not going to vote for you at the next election. That mechanism is not there. And so that does slow down the pace of change when there are obviously accountability problems.
We've got off track here, Stephen. We're running out of time for questions. Can I jump forward and ask another one?
You certainly can.
Bert says, I've not invested in bonds before, and with the election result in the US, I'm not sure if now is the time. So a couple of questions. Should I invest now? Not sure about that. What are the implications for buying Australian bonds if Trump executes some of his policies and we are impacted by the trade mix on China? Finally, US or Australian government bonds, or a mix, individual buys or an ETF. Now, this is a tough question, Stephen. Bonds are selling off right at the minute.
Well, that's right. The biggest impact of Trump the first 7 days has been bond prices have fallen. So if you're an asset owner of a bond, because the yields have gone up, particularly at the long end, yes, everyone's talking about the financials are booming and the stock market's at a record high, but bond prices have fallen because they move inversely with yield. So, and there's going to be a truckload of new issuance. That's the other point. I mean, if you're running, massive deficits year on year into the future, then that's a supply issue as well. I mean, just the Queensland and Victorian governments together are going to be issuing 142 billion of new bonds over the next 4 years on their current trajectory. That's in addition to rolling everything. So I also worry about the supply question with bonds. How much is too much in terms of what the private markets can accommodate?
Yeah, good point. I mean, Bert, I think you've got time. The bond market's going nowhere. This is general advice only. You've got to stress that. But I reckon you've got time to just see what happens as Trump comes in, see if the bond market settles down a bit over the next 6 months or so, and then you might be in a better place to make a call, I reckon.
I think that's right. Now, look, let's have one last question. Well, maybe this is a comment. Matthew from Financial Advisor at First Financial is correcting us last week for our concerned parent with a son in the balanced ethical fund and whether they should be in a growth fund or not. And Matthew's basically saying that they're not mutually exclusive and there is such a thing as a high growth ethical fund. And so we shouldn't have, and I accept this, we shouldn't have run the line that if you're going to be ethical, you're going to get inferior returns. That is not actually strictly correct. And I actually saw a bit of that at the Nuix AGM yesterday, James, where Nuix was, the Macquarie data analytics firm that was a total dog and was scandal-riven. And anyway, it's come back incredibly. The stock has just surged and they're totally booming and it's a massive turnaround story. And the second biggest shareholder, with I think it was 6 or 7%, Australian Ethical.
There you go.
And they've had a boomer of a return by buying into Nuix when it was down in the dumps before this amazing turnaround story. So they've bought Nuix, they're Australian Ethical, and they've had a massive, 3 or 4 bagger out of Nuix. So you can be ethical and make money. And I think we take Matthew's point and happy to correct the record.
No, I think it's a good point. I mean, even though I must say a sort of regular feature of a lot of ethical funds at the moment is the big tech companies, which is interesting because they're going to spend a lot of money on high emitting data centers that need a lot of energy and water. So that's an interesting sort of ethical ESG issue coming up in the tech sector. So maybe one that Nuix will have to address at some stage too.
Indeed. All right, James. Well, you've got columns to write. I've got AGMs to go to. So we'll wrap it up there. Thanks for listening to today's episode of the Money Cafe. I'll be back next week with Grandpa Cola. So send in a question and we'll answer it together by emailing themoneycafe@eurekareport.com.au. Until then, I'm Stephen Mayne, intelligent investor contributor, founder of Crikey, and shareholder activist.
And I'm James Thomson, senior Chanticleer columnist at the Australian Financial Review.
And we'll see you next week.